All right, everybody, we have another important company reporting earnings today, one that is a general barometer of the health of the Canadian consumer and the overall Canadian economy, and that is Dollarama. You're going to have to bear with me in this video. They don't have a investor presentation out, that shows quarterly slides, things like that. So I'm going to be going over the numbers on just a raw basis. I know it's kind of hard to read, but I'm going to try and mix this up and get some visuals for you so you can get a good idea of the company's overall results. So let's dig right into it. And remember, as always, research on 3 stocks in the description below from our premium platform, absolutely free. And I'm also going to drop a link to a free case study down below. We did a comprehensive study on a very popular Canadian investment strategy. And let's just dive right into the quarter. So Dollarama reported a 3.3% increase in comparable sales and a 6.5% increase in diluted net earnings per share. So this came in at 98 cents and total revenue came in at 1.562 billion. So when we look to actual analyst estimates, we can see that these actually missed on both the top and bottom lines. Market had expected 98.23 cents and revenue of 1.57 billion. So this is not a very big miss. I really don't think it's all that concerning. But when we head down here and actually look at the company's estimate trends, this is the first quarter that Dollarama has actually missed estimates on an earnings and revenue basis for, what would that be, Q2 2023, and this is only the available data I have. It could span actually beyond this, but over the last 2.5 years, this company has never missed top and bottom line estimates. We can see here for revenue, they generally match the last 2 quarters and they've effectively beat every single quarter below. So that top and bottom line miss is certainly something to keep an eye on, but is not something I'm overly concerned with, really. When we head back to the quarter, the one thing I want to speak about now is that comparable sales growth. So comparable sales, again, 3.3%, but it says here over and above the 11.1% growth in the corresponding period of the previous year. So what they're effectively saying here is that they were able to grow comparable sales last year by 11.1%. So effectively what they're saying is they had a ton of comparable sales growth last year and they're still growing comparable sales growth this year. So in a nutshell, what they're saying is it would be very hard for them to maintain this 11.1% comparable sales growth moving forward. So they're kind of just telling you why it's declining, why it's been continually declining over the last while. And if we look to 2021 and, into the midway point of 2023, we can see crazy comparable sales growth. And again, I've mentioned this numerous times. Why is this? Well, what happened, in late 2021, early 2022, particularly, early to mid 2022, interest rates started rising. The cost of living in Canada was getting crazy. Inflation was at absurd levels, and Canadians had, changed their shopping habits dramatically. I mean, look at this comparable sales growth. I mean, Dollarama has typically always been a company that reports low, mid-single digit comparable sales growth. So to see this, accelerating to the point where they're, year over year comparable sales of 15.9%, that is nuts. And that is not something that could have ever been maintained. I don't think the market expected it to be maintained. And I do believe that this 3.3% comparable sales growth over and above the 11% they reported last year is still very strong. However, the market might not like this gradual decline and might be wondering at this point when it's going to bottom, because we've had a lot of growth pulled in, a lot of, comparable sales growth, overall growth that the company might have not expected for, 3-4 years. We've had that all pulled in to the previous year effectively because of that surge in shopping shifts. Nobody really could have expected this, and that's why the company has done so well over the last while. I mean, if we look to the company's stock price, we're seeing still year-to-date returns of 55%. However, over the last while, it's kind of flatlined because it's reported 2 quarters of not slowing growth, but lower growth overall. And I think relative to what the company is being valued at, this is probably why we're seeing that, 4% decline. Probably because this is one of the weaker quarters the company has posted in the last while. And by weak quarter, I don't mean weak quarter at all. I'm just meaning, relative to what has been reported in the past. I mean, if we look at a value score, Y-Chart's value scores, which are, I utilize them quite a bit in terms of overall valuation, we can see a 2 out of 10. So I'll get the valuation in a bit, but I do want to head back to the quarter. So we're looking at EBITDA. It increased by 6.5%, and it represents a EBITDA margin of 32.6%, which is a boost from last year. However, we're looking at operating margins that are not, I don't want to say declining, because they're only down 10 basis points year over year. But the one thing about this company is it was able to grow free cash flow. It was able to grow earnings at a big pace because of operating margin expansion. So now, if these operating margins, if the market feels that they've probably flatlined at this point, they're probably to, stay in this range, that might be an element as to why the company is taking a dip this morning as well. I mean, when we look to the company's overall operating margins, we can see leading up to the pandemic, 23.86%, but then they went through a relatively decent decline. And I mean, we can expect this during the COVID-19 pandemic. If you think of all the things that Dollarama had to do during the COVID-19 pandemic in terms of, prepping the stores for shopping, things like that, there was a lot of operating costs that come from that. And as a result, margins took a hit, not a huge hit, but they did take a hit. But now we've grown from, 20.9% margins in January 2021 up to, Y-Charts reports 24.66. There's a little discrepancy in this data, but this is also from last quarter. So we're looking at operating margins that have somewhat stabilized. And the one thing I'll say about Dollarama is these are the best operating margins in the dollar store business. I mean, if we go to something like Dollar Tree, you're going to see that the margins aren't even close. If we head to Dollar Tree, we can see operating margins of 0.33%. They're barely breaking even on that point. And so obviously 26.2% for Dollarama is outstanding. And there's a reason why Dollarama has crushed Dollar Tree over the last while, and that's pretty much it. So we look to earnings per share, 6.5% growth, and the one thing I will show you here is revenue and free cash flow generation. So we can look at Dollarama, pretty steady upwards trend leading up to the COVID-19 pandemic, then a little bit of a flat line, but the key accelerated growth here was in 2022 and 2023. I mean, we can even see this notably from a free cash flow per share perspective. And again, that was that dramatic shift in the company's, foot traffic, all that type of stuff, because of the absolute surge in the shift of the Canadian consumer. So we saw free cash flow per share. We can see it's, around $2.40 during the bottom point in 2022, and then we can see $4.48. But the one issue here again is we're seeing a bit of slowing growth in that regard, and the company is just, they've absorbed a ton of revenue, free cash flow, earnings per share that they likely had projected would be later in the future had this big shift not occurred. And as a result, you've likely seen a lot of Dollarama's returns being pulled in now. Like, they are unlikely to continue the accelerated monumental shift they've had in share price. I mean, we can see 1 year returns 49%, 3 year returns 166%. I do believe a lot of this has been pulled in, and I don't think the company is going to be able to maintain the levels of growth, again, this comparable sales growth that they did during the pandemic. So when we head back to the quarter, we're going to go to a pretty positive note on the company, new long-term Dollarama store count in Canada. So previously, the company had expected around 2,000 stores in Canada by 2031. And if we look to the store count right now, they're at 1,601 stores as of the most recent quarter. This would be, effectively 25% growth through the next 5 years, which is very strong. I mean, the company is compounded at 4.73% annually since 2019. They now expect 2,200 stores by 2034, and this would be relative to their store count right now, around a 3.8% compound annual growth rate on stores. So if we look to the compound annual growth rate of the past, it's at around 4.73%. So this is a slower overall store growth for the company. However, it's Obviously, they're not going to be able to grow at the pace they have in the past. I do believe, that near 4% compound annual growth rate on new store openings is a pretty positive for the company moving forward. And this increased guidance is definitely a positive. Now, the other key thing for the company is they acquired land for development of a logistics hub in Western Canada. So ultimately, what this is going to do, it's expected to open in the fourth quarter of fiscal 2025, and it's going to cost around $450 million. But what this will do is allow the company to increase its distribution efficiency, which ultimately should help it improve that margin profile overall. So that is ultimately a good thing as well. Obviously, if it can build distribution networks, on a cost-effective basis, it's going to be able to improve margins. It's going to be able to improve revenue. It's going to help with inventory, things like that. So share buybacks. During the third quarter of fiscal 2025, they bought back 1.36 million shares for total cash costs of $186 million. Now, when we look to Dollarama's total share buybacks over the last while, we can see that they have been reducing shares at a pretty steady pace over the last 10-year period. This is expected to continue, and the one thing I do wonder is whether or not this is, efficient buybacks at current valuations. And if we go to a buyback chart and we actually add in the company's price to earnings ratio, we can see that the company historically, has bought back shares anywhere from, 25 to 29x earnings. Now we're looking at the company trading at around 37x earnings. So they have historically bought back shares at cheaper prices. They're definitely buying back shares right now at what I would feel is high valuations, which ultimately, I wouldn't say this is a bad use of capital, but probably not the best. But if the company doesn't feel it can utilize that capex in other ways, like growing new stores, etc., it's probably not a bad idea, because I do expect the company to post reasonably strong growth over the long term. The only thing that I do believe is, as mentioned, this big surge in growth, I think a lot of forward growth has been pulled into the stock price right now. When we look to outlook, not much has changed. So the ranges for fiscal 2025, they expect 60 to 70 new store openings, comparable sales of 3.5 to 4.5. They're well within that target. They're well within the margin target, and they're well within the capital expenditure target. So outlook looks pretty good. I do believe the slower than expected, because the 3.3% comparable sales growth does come in below the company's annual guidance. Along with that, the missing of the estimates, that might be why they're taking a bit of a hit right now, but it's still been a very good year for Dollarama. So the last thing I do want to go over is the valuations, because a lot of people, they look at companies that have gone up 160, 170% over the last 3 years, and obviously we're drawn to higher returns. So people are ultimately wondering if the company is still a buy right now. And there is no doubt that it is expensive. It's trading at 36x trailing earnings, 31x forward earnings. It's looking at, we're looking at 31x trailing free cash flows. Typically, this company is traded at 24x over the last 5 years. 10-year median averages are just under 29. So from a free cash flow perspective, it's not showing that it's crazy overvalued relative to historical averages. The PEG of 3.69 suggests that, again, as I had mentioned, I do believe there's a lot of growth pulled into this company right now. PG effectively measures the company's forward growth and compares it to its price today, and kind of gives you an idea as to whether or not the market has priced in that growth. And I mean, this is obviously one metric of many, but it does show that the company, does have, a lot of growth currently priced into the stock. So if we look to total estimates, we can see from an annual perspective, the company is expected to earn, we're looking at mid double-digit earnings growth for 2025. But then when we move forward, we're looking at, low double-digit earnings growth moving forward. Same for 2027. And for a company that's trading at 31x forward earnings, this is a growth rate, a valuation multiple that you would expect from a company that is growing at a faster pace. But there's also the added element that Dollarama, depending on the health of the Canadian consumer moving forward, depending on, how their habits shift in a falling rate environment, whether or not Canadians ever shift back to, the more higher cost discretionary spend at, stores, higher item stores, maybe they don't feel that need to shop around anymore. I do believe this shift is permanent, and I do believe Dollarama is going to benefit from it a lot moving forward. However, the only thing that I believe right now is a lot of that is priced into the stock right now. So in order for it to continue that accelerated growth moving forward, we're probably going to need even more Canadians shifting to a discount style of buying, a discount style of shopping. And I think a lot of that was absorbed back in the 2021, 2022, 2023 situation. So I pretty much expect this company to, at this point in time, grow in line with earnings. If we see a continued slowdown in comparable sales growth, we may see a bit of a valuation reset, but you can probably expect, if this company is going to grow earnings at a low double-digit pace, I would imagine that that would probably be the overall return of the company from an annual basis. But I don't think you're going to see this anymore. I don't think you're going to see that 167% return over a 3-year period. I do believe that's all been priced in. Would I buy Dollarama right now? I would say you're not getting as good of a price as you were previously, but as a defensive retailer, margin improvements moving forward with capital expenditure spend continue to boost margins. There will probably be strong free cash flow growth here. I probably wouldn't argue with anybody buying Dollarama right now. Would I buy it right now? Probably not. I believe it's a bit too pricey. But moving forward, I think it's a relatively strong stock to hold right now. And again, as mentioned, I do believe it'll probably just grow in line with those earnings. Overall, pretty solid quarter from the company, but just not as good as it's been in the past. So that's why I think we're seeing this 4.35% drop this morning after reporting earnings. So everybody, that's it for the video. Really hope you like it. Let me know if you like me going over these earnings recaps. I do love producing these videos, but ultimately I want to produce videos that you want to watch as well. Head down below, like the video, subscribe to the channel, grab your 2 free reports in the description, and we'll see you next time for more great Canadian content.